Let's talk about new fund offerings by mutual fund schemes. Joining me to talk about that is Santosh Navlani, the Chief Operating Officer of ET Money. Thank you so much, Santosh, for taking the time as always. And good evening. Happy Friday to you. Let's talk about the new fund offerings that are currently open. And also, there has been a bit of a gap, hasn't there, in the new fund offerings? They were coming thick and fast earlier in the year, but now they're back, I guess, with a bang.
Hey, Alex, and happy Friday to you as well. Maybe have a great weekend as well. Yeah, so I think we are seeing a flurry of NFOs starting from 1st of July or so, simply because there was a ban or embargo on the NFO by Sebi, because there was some kind of a more important operational improvements or other enhancements that SEBI wanted to do for the investor benefit. And hence, for that time, the NFOs were almost like not allowed to get launched. So right now, because of the backlog, you are probably seeing way too many options on the NFO side. And some of them definitely are on the positive side, where we are seeing a passive fund offering and factor funds offering and ETFs as well in the marketplace. So it's a great time to really look at some of the passive offerings which people may not have seen. But whether one should be doing from NFO as a way to do it or later, that is something probably we can address during the course of the show.
Why is it that you should not really go for an NFO? Why is it disadvantageous?
Yeah, so as ET Money, we've always believed, Alex, that when you are actually investing in any product, be it traditional investment products or even mutual funds, you need to always weigh all your alternatives and then decide what is best suited for you. And when it comes to mutual funds, there are possibly thousands of schemes. I would not even have an exact count of number of mutual funds available in the marketplace today, but there are thousands of options available for people to choose from. And there are over 36, 37 categories of mutual funds in total. And almost every fund house worth its salt will actually have most of the retail categories pretty much covered today. So it's not that somebody is doing an innovation in the marketplace by launching a new category of fund, which is completely missing from the bouquet today. So when you're looking at any NFO, whether it is a passive fund or a factor fund or traditional actively managed funds, you should probably know that it is not something really new, which is not available in the marketplace. It is already, some other fund house will be having a couple of funds in the marketplace. So let's look at multi-cap as a category. So we as a country always had multi-cap, just that some time ago, SEBI introduced a new category called flexi-cap and said some of the funds we were actually multi-cap can become flexi-cap if they wish to, or launch another flexi-cap of their own. So some fund houses actually renamed or recategorized their existing multi-cap schemes into flexi-cap and then launched new multi-cap schemes. So when you look at multi-cap as a category, you should know that there are already probably tens of funds available in the marketplace today, which you can compare performance in bull markets, bear markets, upside, the alpha it is created against the benchmark and things like that before taking a call. So one has to weigh all the options, and when an NFOs comes in by a fund house, one doesn't know how to evaluate that strategy. It is only about a pitch deck or a scheme brochure that you will get, and you need to take a call on that leap of faith instead of looking at hardcore data or performance. So one reason I believe is there are multitudes of possibilities available in the marketplace to invest in. There's no need to reinvent the wheel. And when you're inventing the wheel, you should know exactly that you are buying into a leap of faith and not into hardcore numbers.
In a sense, Santosh, if people are not watching this show, or if we have not, they've missed this particular chat, there is a hard sell when it comes to NFOs, isn't there? And so what are the kind of things that distributors or maybe a broker would do when they're trying to sell these NFOs? Because at the end of the day, they are products like anything else.
Yeah, I think one of the I get surprised honestly at many times even today that many times the distributors in the marketplace actually sell the fund with a pitch that it is a new fund offering and it is being offered at 10 rupees, a unit. And if you look at existing funds in the category, the NAVs upwards of 500 or 600 or whatever that may be. And because you're buying it so cheap, you have an option, or you have a possibility that you also will probably see 50x growth over the next 10-15 years, and we will fall for it, unfortunately. What they don't realize is it's not a stock market unit. It's not a share that you are buying where it has a potential to really multiply from here. Technically speaking, when there are, it's like, people compare the NFO with an IPO of an offering, new share offering in the marketplace. What happens is the number of shares that a company is issuing in the marketplace are actually fixed in nature. Hence, there is possibility if more people are interested, the price will go up because there is demand supply mismatch. Unlike that in mutual funds NFO, that kind of sort doesn't happen. If tomorrow a fund house is willing to raise 5,000 crore, they will issue 50,000 five so many units of rupees 10, and not bother about whether I'm getting 5,000 crore, 10,000 crore. They will proportionately increase the offering size because they can create unlimited number of units, technically speaking, and raise the money, go and deploy. So one should understand that the 10 rupees, prey that people fall to is actually very detrimental to the growth. The fact of life is from 10 rupees, if there is a new fund coming in the marketplace and there is existing fund in the market at 100 rupees, both of them in the same category have theoretically equal chance to appreciate by 10%, 100% or 1,000%. So it may be. It's not that just the new fund offer, because it is coming at 10 rupees, has a higher revenue, higher profit potential or return potential. So one big trick, I think probably this is the only trick the NFOs or the distributors use to attract people to NFOs. I think people should not fall prey to it because NAV over there has no meaning.
Fair enough. But why? Okay, then let's talk about the fund house themselves, right? You spoke about categories and you spoke about certain reasons why NFOs are launched in the first place, but talk about what fund houses themselves do. They're using these to plug gaps in their portfolios, for example?
Of course. So, Alex, no, a fund house is probably never wrong in launching a new fund because, see, the fact is there are upwards of 40 mutual fund companies in the country. All of them have launched at different points in time. Every fund house first launches the category that they feel very confident about doing justice to. They build up their name by providing great returns in that category. And then they try to launch different funds in different other categories as well over a period of time. So if there are 36 or maybe more number of categories in mutual funds today across equity, debt, hybrid, which Sebi allows a fund house to launch, it's not possible for a fund house to launch all 36 categories at one go or finish the entire bouquet in like 3 years. They take their own sweet time depending on market conditions, investor sentiment, flows in the marketplace, market potential to generate returns over next 1 or 2 years. Ultimately, you need a healthy atmosphere to be able to attract assets. So they are not wrong in launching those. Most of the times, they will only be looking at what kind of fund categories are attracting investor interest, where they are missing, can they provide an option and possibly gain as a business from the attraction of flows in that category. So they will have their own business rationale for launching it. But as an investor, you should be looking at why do I need to really invest in NFO when there is already 10 different 15 fund houses offering same category of funds, which have demonstrated great performance during bull markets, bear markets. There is a sense of believe that a fund manager is following a certain strategy which is working for them. And of course, you basically also have experience of investor communication, servicing that the fund house provides, and other softer aspects of the brand. I don't see fund house being wrong, as I said, in launching multiple products. It's about, as an investor, you need to know whether a category of funds being launched is fitting into your portfolio where, and should you be buying an NFO or an existing fund in the marketplace.
I guess an interesting analogy, Santosh, would be if you compare mutual fund schemes as investment vehicles and you compare it with the automotive space, and an automaker to plug a gap in their portfolio will launch, for example, an off-road SUV and it's glitzy and everyone's talking about it and it's the greatest new product out there. you don't necessarily go and buy an off-road SUV because you don't go off-roading. You're driving in the city and you're driving on road. But having said that, would you agree that a lot of times mutual funds or fund houses try to capture a theme with these NFOs?
Of course, they do so, Alex. So, as I said, they are businesses running for profit. They have all the right to plug in gaps, look at market segments, look at opportunities to attract flows, and of course, make revenues and profits. So, ultimately, as investors, retail investors, what do? We identify profitable opportunities for ourselves and invest in them. And mutual funds are one of the best vehicles that are available to retail investors. So there's nothing wrong there. What is the fund house also is most of the times being very, very cautious that if I'm launching an auto sector fund, am I really doing justice in the marketplace? Are there enough opportunities available where I will provide good investor experience? Because ultimately, if an investor invests in an NFO and he or she is bound to look at performance after a few months, quarters, or years, depending on how active or passive investor you are. If the performance is not coming, you actually blame the fund house and the brand gets suffered. So technically speaking, fund managers or fund houses will not launch a kind of a new fund in a specific category which they are missing at a time when they don't believe they can do justice or provide good experience over the next 2 years in terms of returns.
If I look at the current list of NFOs, there are three factor funds and smart beta funds. Should one look at these funds differently or these NFOs differently?
Yes, so they are not technically an actively managed fund where you need history of performance to make a judgment whether you should be looking at that fund compared to the competition or not. These funds like smart beta, passive, kind of factor funds, they technically can be looked upon as a fund which on the day of launch has a history of a decade or more. So look at, for example, a momentum ETF, which an ICICI Prudential mutual fund is launching, or index fund they're launching together, or for that matter, any kind of Nifty 50 ETF being launched by a fund house. So what you can look at, the factor funds or ETFs or passive funds like index funds, they track an index, and index technically has a history of performance based on back testing, maybe in terms of being available in the marketplace as Nifty or Sensex of 15 years, 20 years, 30 years sometimes. And you know that how that index has behaved in the past in bull markets, bear markets, and flat markets as well. So you don't need to hold back your judgment for lack of performance data. If you believe this is a kind of factor which I would like to really put my money into, be it value, momentum, low volatility, or quality, I should be investing. Go ahead and invest, but keep in mind that you can also invest after the NFO period. You can also invest on day one of when the fund gets available for repurchase, because by definition, when open-ended funds are available, that means you can invest and take your money out whenever you want. So at the NFO period, anyways, lasts 15 days. And after 2 or 3 days, the funds become available again for purchase by everybody in the marketplace. So the rush to invest in NFO, and just because you miss the deadline, should not bother you that you missed an opportunity. In my opinion, you should actually never invest in NFO period itself. You should invest on day one if you believe that the investment idea is great for you. You will not lose or make up more just because you invested on day one instead of NFO.
But how long then, if we're talking about, you've made your point on passive funds, right? But how long with regard to an active fund or an active fund NFO or a new fund for that matter, should you wait? How long should you wait till you understand how the performance is? How much time do you give it?
Sure. So I think it's all about a business cycle, Alex. So typically you can't judge a fund's history of performance or capability of giving you performance only in a one kind of market situation, be it bull or be it bear. And typically you would see a bull market lasting for a couple of years, a bear market maybe lasting for a few quarters, sometimes couple of years. So by definition, you would end up looking at a market cycle, a full market cycle, as a period of 3 to 4 to 5 years minimum, if not longer. So giving a benefit of doubt at max, I would say that you should at least look at 3 to 4 years of performance for equity schemes, and maybe at least 2 to 3 years for debt schemes before you decide whether it makes sense to invest in that fund or not. I would add just one thing, that sometimes there can be exceptions where NFO period can be attractive time to invest. And it happens when, for example, Bharat 22 ETF, when it was launched, where, so I guess it was available that if you purchase during NFO period, then you would probably get extra units, or you will get some discount on the NAV. And if that kind of stuff is available, and it's a category you feel you should be investing in, you may take a kind of bet on that side. But if there is no benefit, you should not be, and wait for 3 to 4 years for an equity scheme to really show whether it's worth your money or not.
So I think we've had a very useful conversation. Santosh, thank you so much for taking the time, and wish you a very happy weekend.
Thanks, Alex. Same to you.